In September 2008, some of the most powerful financial institutions on Earth were running out of time. Banks stopped trusting each other. Markets were collapsing. Companies that had survived wars, recessions, and crashes suddenly looked vulnerable. And at the center of it all was something millions of Americans considered completely ordinary: a mortgage. For years, American housing had seemed like one of the safest places to put money. Home prices were rising, credit was widely available, and millions of people were encouraged to believe that property values would simply keep going up. Banks issued mortgages to borrowers across the country, including increasingly risky loans to people with weaker credit histories. On its own, a mortgage is simple. A bank lends money to buy a house. The homeowner pays it back over time with interest. But Wall Street discovered that thousands of those mortgages could be bundled together and transformed into financial products that investors could buy. These were mortgage-backed securities. Suddenly, the monthly mortgage payment from a house in Arizona or Florida could become part of an investment owned thousands of miles away. The system grew. Banks made loans. Those loans were packaged and sold. Investors around the world bought securities linked to American mortgages. And because housing had performed so well for so long, much of the system appeared safer than it really was. Financial institutions also used enormous amounts of borrowed money, leverage, to increase their potential returns. When prices rise, leverage can magnify profits. But it works in both directions. When the value of an asset falls, leverage can turn a manageable loss into a devastating one. And eventually, American house prices stopped climbing. Mortgage defaults began rising. The securities built on those mortgages started losing value. The machine that had looked incredibly profitable was beginning to run backwards. By early 2008, the warning signs were impossible to ignore. Bear Stearns, one of Wall Street's major investment banks, was collapsing. In March, J.P. Morgan Chase agreed to acquire the firm in a deal supported by the Federal Reserve. It should have been a terrifying warning. Instead, the financial system continued moving. And just 6 months later, another institution was approaching the edge: Lehman Brothers. Lehman Brothers had existed for more than 150 years, but by September 2008, it was carrying enormous exposure to real estate and mortgage-related assets whose value had collapsed. Over one frantic weekend, government officials and Wall Street executives searched for a solution: a buyer, a rescue, anything that could prevent the firm from failing. Nothing came together. On September 15, 2008, Lehman Brothers filed for bankruptcy. At the time, it was the largest bankruptcy filing in American history. Images of employees leaving Lehman's offices carrying boxes became one of the defining symbols of the crisis. But the real danger wasn't simply that one investment bank had disappeared. It was what Lehman's collapse revealed. Nobody really knew who could be next. Fear spread through the financial system. Institutions became increasingly reluctant to lend to one another because they could no longer confidently judge who was exposed to toxic assets, or by how much. Credit is the bloodstream of a modern economy. Businesses borrow to pay employees, purchase equipment, and expand. Families use credit to buy homes and cars. Banks rely on confidence to lend to one another. When that confidence disappears, problems on Wall Street can rapidly escape Wall Street. Insurance giant AIG was also in severe trouble, largely because of enormous exposure through financial contracts connected to credit risk. The U.S. government intervened. Markets continued falling. What had begun as a housing problem had become a crisis of confidence in the financial system itself. And eventually, the damage reached people who had never bought a mortgage-backed security or worked on Wall Street. Businesses failed. Unemployment surged. Families lost homes. Retirement accounts fell with the market. Global trade and economic activity contracted. Governments and central banks responded with extraordinary measures designed to stabilize the financial system and prevent an even deeper collapse. Those decisions remain debated today. But the lesson of 2008 goes deeper than any single bank, regulator, or policy. The crisis demonstrated what can happen when risk becomes distributed across a system so complex that almost nobody can see the entire picture. Millions of individual mortgages had been transformed, packaged, leveraged, and connected to institutions around the world. For years, the system worked, until it didn't. And perhaps the most frightening lesson of 2008 wasn't simply that the financial system failed. It was how safe much of it looked just before it did.